Huge news, guys. Just our first rate cut. If you're wondering what that means for you moving forwards and the future outlook on rates, make sure you stay tuned and watch this video.
Hey guys, Josh Ehren back for another Finance Friday. In today's video, we are going to discuss interest rates and rate cuts. And today, you're probably seeing this video, it's a few weeks after when we shot this, but today's actually important today. Today is the day that the Bank of Canada actually made their first cut to the overnight lending rate. So in honor of that, we wanted to create a video all about interest rates, what to look for, what's happening right now, what we can expect, and how it's going to affect the real estate investment market in Canada from our perspective. So let's dive into it. Today was a pretty important day. We've had a rate hike cycle for the last roughly 2 years, 2.5 years. A lot of pain in the market. It has done what TIF wanted it to do. It has drawn all the money that was printed during COVID out of the economy, and unfortunately, there's a handful of indicators going off right now that are causing the Bank of Canada to start to cut rates, that being increased unemployment, lower CPI data is coming out, and if you talk to anybody recently, most people seem to be struggling. So if anybody listened to the Bank of Canada announcement today, they did outline that unlike previous rate cuts, they don't anticipate this to be quick rate cuts one after another. They anticipate this to be drawn out, whereas they're going to cut rates, wait and see what happens with CPI growth, and then cut rates again. They don't want a situation where inflation gets out of control again and we have to go back to increasing interest rates and tightening the economy.
Yeah, so 25 basis points today. In June, July, I think they're also predicting another 25 points. Should be down 50 points by the end of the year. I think we get, as we get closer to the end of the year, getting in November, taking a look ahead into, Fed election time, I think they're going to want to wait and just kind of see what happens with the election results there and where their economic policy is going to be moving forwards. Obviously, the rate cut is great, but as the Fed kind of holds their rates, it does put a little bit of dampening on the power of the Canadian dollar. We don't want to be making our cuts too fast, too quick. Not only just, as Josh mentioned, we don't want to spike inflation again, but you also don't want to devalue the Canadian dollar too much, right? You want to be able to keep that, dollar as strong as we can, even though we're unfortunately not in a great overall position right now. So, when it comes down to the conversation, the talk around interest rates, and we need to drop it as fast as we can because people are suffering, I think there just needs to be a little bit more consideration in terms of what does that do for the Canadian economy in a multiple different ways. Obviously, if we drop rates too fast, housing prices are going to start to soar. So even though the conversation right now is things feel unaffordable, but if housing prices go up again, another 40%, well, even though rates are down, again, the increase in housing prices is going to push things, out of affordability for the majority of Canadians, as we already saw over the last couple of years. And then again, we just want to keep that dollar as much as we can on par with the US dollar.
Yeah, really interesting to see what is going to happen and how they're going to soft land this recession that we're in. Realistically, I think Daniel Foch posted the other day about how many rate cuts are priced in based off all the G7 countries, and Canada had the most priced in rate cuts out of any of the countries. I believe they had 7 priced in, whereas the United States had 5 or 6, and then Japan, I think, had 2 rate increases. It does say a lot about, realistically, what kind of economy do we have? Is it a healthy economy that requires this many cuts and this many rises at the same time? It'd be nice to find some sort of equilibrium here. Where that is, unfortunately, when you print stimulus and money into the economy, it's a lot like a drug. Everybody needs it and wants it to be able to move things forward. Because our economy, our GDP isn't really from creating things. We're a consumer country. We don't create things. We outsource all of our natural gas and all of our resources, our timber, our lumber, our coal, and and essentially a lot of us, the immigration comes in and we just consume. So going to be interesting to see exactly how we go about dealing with the CPI and the GDP growth.
So when we take a look at the rate cut that we just had, the Bank of Canada just cut their overnight lending rate. This is essentially the rate at which these banks are lending to each other after hours. Your overnight lending rate is going to impact your revolving lines. It's going to be your unsecured line of credit, your home equity lines of credits, your variable rate mortgages, and your credit cards. So all these revolving types of debt, this is going to be, in this case, benefited by a rate cut. If the rates had happened to have gone up or it stayed stagnant, you either wouldn't see a change or you would potentially see a change in your monthly payment. So again, rate cuts, that's going to help anyone that's on a variable rate, and it's going to help reduce some of the other interest as well too. Over time, the Bank of Canada, the overnight rate being cut, it's not going to directly impact and lower your fixed rates. The fixed rates are more based off bond yields and expected outcomes from the economy and how we're progressing forwards. But the overnight lending rate being cut is a little bit of a signal that's going to inadvertently have an impact on fixed rates moving forwards.
Yeah, it's interesting because we deal with, obviously variable and fixed rates, but you also deal with a lot of CMHC insured debt. And it's interesting to see the rhetoric in the market and how perception changes and how fast that will change bond yields. The CMB today, drastically dropped to 5 and 10 year on the information that came out from the Bank of Canada cutting rates. But fundamentally, does it drop by 25 basis points the same incrementally as the Bank of Canada drops their overnight lending rate? No, but the bond yields are really an effect of the perception of the bond traders and where they think the economy is going. And in a sense, bond yields are guaranteed returns on investment. So if there are limited ways to be able to create money in the open market, people will take their cash and they'll put it in bonds, and that'll give them a preferred return or a guaranteed return. If the Bank of Canada starts lowering interest rates, that means stimulus is in the market. People will take their money and they'll go put it in the open market to be able to create a return. So essentially, does it one for one affect it? No, but if we're moving in the right direction, everybody has the same consensus, it will drive your fixed rate down to be able to give you lower fixed rates. And realistically, we probably expect over the coming weeks to have a lower fixed rate environment as we watch these bond yields start to trend down.
Yeah, absolutely. And like Josh said, even though they don't directly impact it, I'm sure we'll start to get the emails from the lenders that fixed rates are coming down, which is also going to be good. It's going to be a good relief for anyone looking to get into the market. If you have renewals coming up, you have to kind of keep in mind a few different things. If you have a fixed rate mortgage, your penalty to break is all dependent on either your 3 months of interest or your interest rate differential, which is basically taking a look at how the rates are moving forwards compared to your current contract rate. In a declining interest rate environment, because those interest rates are coming down compared to where your rate might have been over the last few years, again, depending on what your rate was, but there's likely going to be a bit of a gap there. Those are going to create your highest IRD penalties. I was actually just talking to an investor the other day. The bank had offered them an auto renewal. They took a 3-year renewal. They were now looking to bundle all of the mortgages together. And to break that 3-year fix, it was going to cost them $45,000. So again, really have to base your mortgage decision and your rate decision off of what you want out of it. If you want long-term stability, that's fine. But if you're going to be breaking that fixed rate mortgage, especially in today's environment, you're going to have a huge penalty on that mortgage. And it was only a $500,000 mortgage. It wasn't large. So, $45,000 to break that, it's expensive. So again, if you're coming up for renewal and you don't know what to do, reach out to your mortgage professional, kind of explain the situation that you're going into, and we can help figure out the best plan moving forward.
Yeah, I think the age-old question that we get all the time is, what do I take right now? Do I take a short-term fixed rate option or do I take a variable rate mortgage? And we're starting to see more people get apt to moving into that variable rate option to be able to ride that train down as we have lower overnight lending rate and prime rate options available. So I've seen a shift, obviously, since the Bank of Canada kind of signaled that they're going to be cutting rates. Most of the clients who are looking to get into the market right now who can qualify, and we have to qualify 2% above contract, and variable is still pretty high right now. But if you can, starting to find a lot of clients starting to move towards that variable option to be able to give them the flexibility and ride that wave as they expect, quite a bit of rate cuts over the next 12 to 24 months.
Yeah, I think over the next 2 years, they're pricing in about 200 points in rate decreases. So, taking a look forward, I think we hope to kind of see rates get back down into the mid to high threes, maybe low fours, depending on whether you're taking a look at, A lender versus B lenders. I think that's probably going to be where the rates are going to settle once we get into a bit more of a stable economy. 3 to 4%, not bad when you're taking a look at interest rates. I think those are pretty solid. When we're taking a look at where we were underwriting and pricing things back 2020, 2021, we were stress testing at 5.25. So if you get that, 3% rate, you're qualifying at 2% above, you're at that 5%. So, it's still going to create a pretty good market for people to get in. And 3 or 4% still pretty low when you take compared to other rates that we've been seeing. So
no, agreed. I mean, even with the 4.99 pricing right now on a 5-year fixed term, I think that even that 4 is signaling people starting to get into the market. We're seeing a lot of first-time home buyers taking advantage of the current situation of not having a million offers. We are still seeing aggressive offers on properties, 5, 6, 7 offers on a property. Still, some people going in no conditions. So it isn't as dead as some people might want to think. Like the competition for an owner-occupied home, but under $800,000, the appetite and the demand is still there for these types of homes, as we still have a supply issue. But as rates come down, obviously there's an inverse reaction between values and cost of capital. So it's going to be interesting to see if the Bank of Canada can taper it to the point where we don't have a massive boom in value in a very short period of time.
Yeah, and if you were sitting on the fence and thinking about getting in and waiting for that rate cut, just know that you and 100,000 other people just got ready to go in and make some decisions, right? So this is kind of the signal that everyone has been waiting for, right? This is that first rate cut. There's a pretty high percentage of 50 points, including this 25, so another 25 by the end of the year. So again, if you're sitting on the fence, now is the time to really start running the numbers and taking a look at what your affordability is, because if we see another 25 points within the year and you haven't made your decisions yet, house prices are going to start to go up as the market gets busier, right? So I think I saw something the other day. There's about 3.5 months of inventory in some of these markets, Kitchener, Waterloo, Guelph area, which is more than they've had in quite a long time, if I'm remembering correctly. So I think with these rates continuing to drop, it's not going to be like that for a while. So, again, just start to have the conversations, run your numbers, and figure out where your purchasing power is and get ready to make those moves.
I completely agree. Guys, if you guys enjoyed this video today, it would really mean a lot to Aaron and I if you hit the subscribe button, hit the like button if you don't already subscribe to us already. It allows us to make more content like this for you. So if you did like this video, please hit those buttons. I would really appreciate it. Until next time, we'll see you later.